This has long been thought of as one of the most defining weeks in financial markets going into the end of the year. And it's easy to understand why, particularly from a US perspective. It's one of the final big weeks of earnings season, including Apple, who reported yesterday evening. We've also had the Federal Reserve meeting on Wednesday, and we did see a slight tweak in the tone from the central bank, moving away from assuring us that we need to see probably one more rate hike in the tightening cycle to instead becoming more data dependent and talking about tighter credit as well as financial conditions, a nod to the move that we've seen in bond market. So that slightly less hawkish tone has been received by markets. It was expected as well, based on the language we've had from various policymakers over the course of the last couple of weeks. And the other key event was the jobs report today. It's always one of the most hotly anticipated reports that we get every month, and now it's no different at a time when the labour market remains tight and resilient. And one of the final things that the Fed needs to see an easing of in order to be confident that the end of the tightening cycle has happened and before it can even consider cutting interest rates at any point next year. And without further ado, let's take a look at those jobs numbers which have just been released. The first thing to note here is the non-farm payrolls number. It's the first thing we always look out for each month. And that came out at 150,000, below the consensus 180,000. But at the same time, last month's number, the September figure, was revised down from 336,000 to 297,000. So between the two, that's a miss basically of around 69,000 jobs. So that's a big miss as far as markets are concerned, and in the right direction as far as the Federal Reserve is concerned. Then there's average hourly earnings, 0.2% on the month, below expected 0.3%. And the reason why this is so important is because we're not yet seeing wage growth that's consistent with the Fed achieving its 2% target. So if we continue to see monthly readings around 0.2%, that should bring the annual earnings figure down from where it is right now, around 4.1%, which is also slightly below where we saw a month earlier at 4.3%, to something that can enable the Fed to say that it's achieving its inflation target over the medium term now, and we'll be able to sustain that over a longer period of time as well. I'd say the one downside here is the labour force participation, which fell from 62.8% to 62.7%. But these small fluctuations can happen on a monthly basis, so we don't need to read too much into that. But all in all, I think the markets have taken this well. I think the net of this jobs report is very positive. I think this is exactly what the Fed needed to see, but also at the same time, it is just one report. We need to see this repeated on a number of months, hopefully consecutive months, to give the Fed that comfort that going into 2024, that we are starting to see cracks appearing in the labour market. They don't want to see a complete collapse of the labour market, but they do need to see some weakness in the labour market to give them that assurance that they are creating that slack that will enable wage growth and inflation to return sustainably to where their targets lie. And with that, let's take a look at a chart. This is a euro-dollar daily chart. And the reason why I've chosen this is because we have seen an interesting development here over the course of this week. And the reason for that is what we actually saw a couple of days ago. It looked as though we were seeing more of a bearish setup. You could see just around here a couple of days ago that we made a lower high from the previous high. That was ahead of the top of that rising channel. And then we saw it move back towards the bottom of the channel and actually move briefly below. There's a couple of reasons why I think that could have been important had it not been for the report that we've just seen. One is that this is effectively a bearish continuation flag formation. Now, I will stress it's not perfect. For one, this is not a particularly sharp decline, but for two, the amount of time that we've seen this flag for has exceeded what you would typically look for in a flag. So you typically look for somewhere below 20 bars. And at this point in time, but depending on where you put the first bar, we're actually closer to 27, 28 bars. So it's not an ideal bearish continuation flag formation, but I'd still say it just about counts. And it looked as though we were potentially eyeing a breakout ahead of the jobs report on the back of what we heard from the Fed. But instead, we've trended higher in the aftermath of that. Perhaps some of that dovish undertone from the Fed maybe started to filter through in the 24 hours following the meeting. And now we've started to trend higher on the back of that jobs report. As I said earlier, the jobs report, I think, is promising from a Fed perspective, and it's enabling the central bank to be less hawkish, which leads or which lends itself to a softer dollar, which is what we've seen in the aftermath of this. What this does, it actually basically means that we've taken out the previous high from earlier on this week, which eradicates effectively what I was saying earlier about the kind of bearish momentum starting to build up ahead of that Fed meeting. But also, it means that we could potentially see a break above this rising channel and above the flag formation, which removes this kind of bearish continuation pattern feel to this chart, and may have traders looking a little bit higher, perhaps at longer term retracement levels, but at least back at other past support and resistance zones. And nothing stands out more than 108. When you look at 108, you can see that this is a past area of support and resistance, which falls around this kind of level here, maybe slightly higher. You can see that when we kind of broke below, when we came down, we saw support around 108, but also it coincides as well with the 200-233-day simple moving average band. That's the two red moving averages here, and the upper part of the 55-89 moving average band as well. I think that'll be the 89-day simple moving average coinciding with that 200-233. So that would be the first test of potential resistance, I feel, if we do see a break higher. But ultimately, the damage will possibly have been done. A break above this rising channel means that we're not necessarily in a bearish continuation phase. It doesn't mean that we can't continue that move lower thereafter, but it would, for me, mean that we're not necessarily paying attention to the trend that preceded it quite so much, or the channel that it's traded in the aftermath. But 108 would be a key area of resistance. If we break through that, then that could be another quite bullish signal as well, at which point I would be inclined to start looking at the key fib levels. So I'm looking from these highs that we saw back in July, and going then to the lows that we saw, of course, in October. And then the fib levels, I think, would be the standout areas of potential interest as far as the euro-dollar pair is concerned, if we are going to potentially see a continuation over the medium term of that downward trend, meaning a stronger dollar and a weaker euro. But obviously, we're getting a bit ahead of ourselves here. I think the most important takeaway is that the jobs report here has been a bearish factor for the US dollar in a week where we've seen a less hawkish Fed, which I think is an important factor as well. But ultimately, we do need to see a lot more data. The final point which I'd state here is that there's a lot more US economic data to come between now and the end of this session. So this could change based on what we get from the manufacturing PMIs, the ISM survey as well, and one or two other pieces of data could have an influence here too. But at this point in time, a combination of the Fed and a softer jobs report has been bearish for the dollar and bullish for the euro-dollar pair.